is going on, chill investors? All right, guys. So, as you guys know, Friday was a mix of somehow some green markets, but a lot of red mixed into that green. So, what I want to go over with is opportunities because that's what we look for. When we're running this wheel strategy, guys, we look for red days, okay? We look for this volatility to come into play. You know why? Because those are just amazing opportunities to capture other premium or just extreme valuation, like extreme value in the market. Okay. So there's a few that we're going to be looking at. I got my 10 right here. Um, I'm a huge believer in HIMS. Again, none of this is financial advice. This is all what I'm looking at the market. So you guys have an idea of how my brain is like processing everything. Just to hear kind of what someone who looks at the market every day and is trading every day, running the wheel strategy, and just the thought process behind it. Okay. All educational reasons. So that way you guys can understand what I'm thinking, why I'm thinking it, and you guys can start thinking the same way. Or maybe I'm not thinking of something and you guys think of something a different way, right? There's many ways to go about things. I'm just showcasing kind of my thought process. All right. So, a few questions in the comments on the previous video were about dollar cost averaging using the wheel strategy. Okay. The same way that you would just buy a stock, right? The stock is 15. As it comes down to 14, you buy some. When it comes down to 13, you buy some. As it comes down to 12, you buy some, right? You dollar cost average into it. Maybe it goes up and you start adding a little bit more as it's on its run, right? Same thing happens with cash secured puts, okay? Just an example on this, like on Weeble right here, okay? Well, we came down near this bottom band, right? So it was, as you can see to the far right, I'll go to the full actually, to the, sorry, I'll go to the bigger screen for the chart. Do I have Weeble? Yeah, there it is. Um, as you can see here, right, we're at 13. So maybe at 13, the strike we were looking for was 12, okay? Okay, well then we got a little more below 12 on this day. Down here we got down to like 11.50. Maybe on that day I now set $11 strike, okay? Well, and then we had a nice rebound, okay, and then we had a couple more bad days, right? We got down to 11.01. Okay, maybe now I set a $10 strike. This is how you dollar cost average setting cash secured puts lower than where the current strike or where the current price is, okay? So same way that you would try to buy a stock when the stock, right? Like here you'd buy just the stock, okay? Then you'd buy the stock again, okay? So same way you would just go ahead and buy, but instead of just buying it, I'm just going ahead and setting lower targets as the stock moves lower, okay? Same way that you would basically just dollar cost average and just buy the stock, but I'm trying to get it where you guys are buying it, I'm still trying to buy it lower, okay? That's the fun part about the wheel strategy. The other fun part is if I can't get it for lower at these extreme deals, then I still get to make money as it runs up, right? So it's a win-win scenario. Obviously, I'm trying to get the shares for as cheap as I possibly can. But if I can't get them for that cheap, I'm still going to make my money. I'm still going to make my, 3%, 2%, 5%. Some of them are 8% returns on premium. Just depends on the volatility. Okay. So that's how we dollar cost average. I usually break it up. I kind of figure out what I want to invest. If I'm thinking that I want to take a $5,000 position into Weeble, I'll divide that 5,000 between 3 or 4 different addings. So like here, maybe I added and did some cash secured puts. I didn't get assigned, so I still have 4 more to go. Right? Okay, now I'm setting them as we're on this move down. Okay. So I predetermine exactly how much I want to invest into a company, and then I figure out how do I want to break that up into how many kind of cash secured puts. Okay. So if we're taking a look, we're going to go through this chart one by one. What I'm going to do actually is I'm going to do it on this all screen. The all screen allows me to, see the 10 we're going to go through. We can see the chart, talk about it, and I can show you the option chain all on one. Okay, so that's going to be the best part. Um, Huge volume, it looks like, on HIMS. HIMS took a beat down, okay? I'm not going to sugarcoat it. The thing I have is First of all, if we take a look at hymns, I don't know why that's kind of like grayed out charting. Um, but if we take a look, just trying to see if that triggered it, at hymns, sure. Are we, at the $50 line? Yes. Okay. But if we take a look, how many days was that? 1, 2, 3 days ago. Okay. We were at 51. Okay. Another week ago, we were at 52. We're at 50, a week and a half ago. The stock has been at this price. Okay. This is nothing new. This is, I think, an overreaction to the CEO maybe selling, I guess, making a little side eye emoji, whatever it may be. It's just noise. I'm not interested in the noise. Um, we're just going to stick to our strategy, right? If you're going to give me a buying opportunity again at this 200-day moving average at 45, I'm going to take it. Okay. So if, as it comes right here, I mean, Monday morning, right? Set a cash secured put, $45 strike. If I can buy it for 45 and collect my premium, awesome, right? It's respected this two. I'm going to go to the bigger screen actually. It's respected the 200-day moving average, okay? If we take a look here, right? Here it is. Every time if you touched the 200-day moving average, you would have bought at 14, okay? And you could have rode it all the way up to 72, right? If you knew how to time the top, you'd sell it at 72. And then again, you buy it again at the 200-day moving average. Here's 25, right? You're going to sell it at 60, okay? Well, here's like a 500% return. Here's another 200% return, right? Okay. Oh, another buying opportunity. You would have bought it at 42. You had a run up to 60. There's another 50% return, right? Buying at this 200-day moving average is a steal every time. It's just a huge buying opportunity. It's been a while since it's been under that 200-day moving average, like well below for a long period of time, right? This is back in 2023. So 200-day moving average, I have no problem adding. That's exactly where I would be wanting to add. So I'd look at the $45 strike. So let's go take a look at that and see what that gives us on a return. Sorry, I'll go here. All right. So what I'm looking at is the again November 21st. Okay. There we go. November 21st, 34 days out. We got 123% volatility, $18 move potential to the upside downside. Um, Again, I'm going to say it's to the upside. I'm super bullish. They have international expansion, menopause, new product lines coming out that have been released. With the international expansion, I think that this stock easily doubles, triples from here. So I have no problem adding. So what are we looking at here? We're looking at a 45 strike on a cash secured put for about 465, maybe 470 if you can get the mid. Just really tight, but and as you can see, this 200-day moving average is right at our 30 delta. I love a 30 delta. Okay, that's exactly where we want to be. We're going to set that 45 and we're going to collect that 465. That's what I'm going to run it with. Okay, so if you guys want this spreadsheet, just so you know, it is in the description link down below. Go ahead and click that. It'll take you right to where you can get it, all right? Strike price, we're looking for 45. The premium was 465 and the expiration date was 11/21, all right? So what does that look like? Okay, that looks like we want to buy this stock if we can get another 10% down. A 10% down move after 2 days ago it was 63. Okay, we've already had pretty much a 20, 25, percent move down somewhere in there, and then we want to be extra greedy and buy it for super cheap. So I really want a 30% discount from a 2-day high. Okay, um, I got no problem. I'll buy it for that. As I've shown you guys before, 200-day moving average is a clear buy on HIMS. Um, I think they have the highest short interest right now, like in the market at 40%. If this thing moves and the shorts need to cover, this thing squeezes, okay? And this thing squeezes to 100, 150, okay? Again, not financial advice. This is what my thought process is for you guys. So you guys can understand where I'm at with the companies I am looking at. So if I can get it for that, awesome. The premium you're going to collect, okay, I'm using funds available. If you had $10,000, it's going to be $10,000 for all these positions, okay? You can go ahead and grab 2 contracts. That is $1,000 in premium, okay? Basically, if this stock does not remain under $45 on November 21st, you will collect $1,000, okay? If it is below 45 on November 21st, you will take your strike price of 45 minus whatever the premium may be. As of right now, at the time of this video, it is 465. Okay. So you will be owning this stock for $40.35. And we have proven $40.35 would be a amazing price to own it for. Okay. Right here, right below that 200-day moving average. Anytime it's gone under, even a better buying opportunity, right? So no problem with that. 34 days of owning it, you're going to have about $30 a day. You're going to get paid in like premium. Okay. Premium is about a 10% return. Okay. So if you don't get to own this stock on November 21st because it's above $45, you still are making a 10% return on your capital. Okay. You're going to make 10% just for a chance to buy this, okay? In 34 days. Let's annualize that and do this every 34 days in the year. That is a 110% return a year. To buy a company that's shown tremendous growth, tremendous leadership, management team, right? This is a play all day. I'm excited looking forward on Monday. This is why we look forward to these red days. Opportunities like this don't come along all the time. As you can see, it was, I don't know, 3 or 4 times over the past year and a half. Okay, so when they come, you need to take advantage of them. All right, so that's HIMS. That's number 1. Okay, next one, SoFi. I'm a huge SoFi believer. They got earnings coming up. They have catalysts, tons of catalysts built into them, meaning, one earnings, one rate cut where they're getting 1 to 3 is the rumor of max up to 3, or somehow they're going to get to 75 more basis points, making a total rate cut of the year a whole point. Okay. I don't care how they do it. They just need to do it. For SoFi's sake, basically, is all I'm saying. Not in general, but they could do one rate cut like they just did, 25 basis points, do 25, 25, 25, or they're going to do the 25 they initially did, a 50 this month, and then figure out which month, the last 2 months of the year, is going to get the final 25 basis points. Somehow they're going to just get to a total of 1 point, is what I believe. I think people like to see more cuts, even if it totals up the same amount. I still think they go, oh, 3 rate cuts is better than 2, even if it totals the same amount of a rate being cut. But that's just a human factor. Okay. But SoFi has been on a tear ever since that April crash. Okay. That April crash came along. I'll go to the bigger screen. Sorry. Sure enough, yep, here's the April low. Once we regain this 50-day moving average, it has not come down to touch it since October. It bounced off of that at 25, basically, and then it ran up to 30. Okay, sorry, coffee. It ran up to 30, okay? And now we're back down, touched it, bounced off of it, went to 29. Now we're down here touching it again, okay? Yes, next week is going to have most likely some turbulence, okay? So what I'm doing with SoFi is I'm waiting for a red day, okay? I want to see a moment of weakness, a little bit of moment of weakness during the day. So this is more of like you're going to have to be there trying to time this, because it's not, when I say moment of weakness for SoFi, I mean like there's going to be a candlestick that comes down here to this 25 range, which isn't far. It's $1, right? It's not a huge drop for SoFi. It's going to need to come down, but that needs to also show support. So buyers are going to step in, and then we're going to close hopefully above this 26. So there's going to be a moment where it comes down to this 25 range. Okay. And then we're going to be looking at what a 30 delta would be at 25. So For example, basically I'm betting on it going down $1, so I would just move if if everything lines up perfectly, right? Where's a 30 delta looking like? Okay, it's at 24, which would mean right if the stock went down to 25 because it's at 26 right now. Okay, instead of 24, that'd be like setting it at 23, right? We just move everything down $1. Okay, so my thought process would be as it approaches 25 range, low 25s. Okay, I'm going to be setting a 30 delta, which would most likely be like a 23. Okay, that'd be my first one. If it can't regain this 50, okay, this 23 would put you right at like a 22, 21.50 um, break even price, meaning that the 23 minus whatever the premium would be, you'd probably own it for if you got assigned the shares, would be about 21.50. Okay, based on what I'm kind of seeing here, right? Um, then if it can't hold that, 22, 21, 19 would be the lowest I would see this stock. And if I see 19 on this stock, I will double down. Okay. Because I think they have so many more catalysts. You know how Robinhood was down here and trickling in the 20s and 30s for a little bit and then back to 20 and then all of a sudden, boom, take off. I have a feeling that's where we're kind of at with SoFi. We're about to have its Palantir Robinhood moment where it just doesn't look back. Okay, and we're getting into that. So this is kind of where I'm like, give me an opportunity and I'm taking advantage. Okay, but I would dollar cost average because if you don't have a position, it'd be a good idea to start kind of building into a position. Um, but I would start doing it the same way I'm saying, set it at 23 as the stock moves closer to that 23 range, right? Then start looking for that 30 delta again, which then would be like a 21. Okay, gets closer to 21, start looking at the 19s, right? Dollar cost average into it. But I would be waiting for it to come a little bit further into this band here at this 25s to start setting my 30 delta down. Okay. What do premiums kind of look like? I'll just base it off of a 30 delta now, 24 to a 1. Oh, that's a nice spread. 148 is what you could get it for. So if you did that, SoFi, okay, strike price 24, $1.48, 11.21. Okay, you're still looking at about a 6% return. If it can't remain under your 24 or your strike price, you're still looking for about another 10% drop in the stock in order to even get assigned. Okay, um, so again, 66% annual return. You can do about 4 contracts with your 10, bringing about $600 in premium over the course of 34 days, right? The reason I love this strategy, if I needed to and I don't get these shares right, the $600, one, I can use it to just grow my capital as far as more money to invest. $600 is just enough to cover, the national average car payment, right? $1,000 a month covers a car payment, covers grocery bills, whatever it may be, right? And then just after this expires and you get this premium in your account, go ahead and, try to buy another stock, right? That's what I love about it. It allows us to make some monthly income to pay for things, and if I don't end up getting to collect the premium, I ended up getting a stock I want to own at a very low price, and the upside potential is amazing. Okay, win-win all around. I love it. All right, so Weeble. Okay, you're gonna have to be patient with this stock, but I am a believer in the stock. All right. I'm not a day trader, okay? I'm an investor. I believe in long-term growth. I'm not going to go ahead and just panic, right? I'm gonna ride the waves. It is what it is. If you believe in a company long term, okay, think of Robinhood for Weeble, okay? And you know how Robinhood's not really international quite yet? They're working on it. They're trying to get licensing and everything, but I think um, America's a little more lenient on regulations when it comes to what Robinhood is probably doing as far as the like poly market stuff where you're betting on this team, is win or lose, just like, yes, no questions. Um, Weeble's also more of like I would say a more advanced brokerage. that is international. They got I believe 16 countries they're in. I think China trade deal helps with Webull a little bit more. Rate cuts help Webull a lot more. Um, so I mean they could be Hood. Robinhood was this same price. Um, they're obviously still new to the market, right? They came out in April. So they're still trying to find their footing in the market and everything, but I still think right now with an RSI of about 31, could you see it down here in the 20s? Sure. But I'm going to dollar cost average because this company could also just start running. So I'm just going to be in it. I just want to be in it. I want to start buying it low and buying it right. Um, so I do have some contracts on Webull. It's not giving us all the dates and times and all that, but I do have 15. I think I do have a $4 premium, so just kind of where it's at now, just maybe a little bit less, just after a red day like Friday. That's expected. But that puts me at about 11, so which would be right where the stock currently is. Okay, so yeah, I'm okay buying the stock for $11. That's what my strike price minus my premium would put me at. It puts me right exactly where the stock is at $11. I got no problem owning it for $11. As you can see, when it found its footing here, right at this baseline, about 1050, right? We had a huge run up. You had to run to 18. Okay, so now we're looking to find our footing again, find that footing, and we can have a nice run up to 18 again, or at least maybe get into the 20s. Okay, that's my thought process on that one. I just want to own the stock. I want to be in the stock. If we take a look here, we just looked at it in our last video. If you didn't see that one, I gave my top 6 plays. And some of these are in there. There's additional ones now added after Friday's move. But what's that looking like? I mean, that's looking like another 9% return on capital. But that's not what you'd be doing right now, okay? So what I would be doing right now is be looking at this. Let's see here. Doesn't look like November 21st is going to give us all the dates here, but the implied volatility is the highest. Okay, so meaning that the premiums are the juiciest on that date. They're not even as juicy here. The reason I like this date for Webull is their earnings are December 3rd. Okay, so my goal is to own all these shares before going into earnings. Um, and if it's already super down before going into earnings, um, I I think the opposite, right? I think a reversal happens when something's kind of trending down. In this sense, not really because of the company's fundamentals, just because the market in general is trending down. Um, I think that the earnings is going to reverse that. Okay, I'm an optimistic person. Okay, that's just what it is. I'm gonna root for the underdogs. I'm gonna root to the upside. Very rarely will I root to the downside because I want everyone to do well, except shorts. Okay, um, but I'd be looking at $10, um, and it looks like. Can I see what $10 is paying out here? 40 cents. So probably on November 21st at $10, you were looking at about a 5% return. 10, 60. Let's plug that in here. All right. So we're looking at bull. Okay, we're looking at the 10. We're looking at about a 65 cents, 11.21. There you go. All right, you're looking at about 6.5%. Okay, right here in line. Again, these are growth companies. We're looking at another 9% opportunity drop in price to try to buy this company. Okay. As you can see, that's kind of where our 30 delta is putting us. Based on Friday is a nice another additional 10% after a bloody Friday, with the potential to just make 6% or more on premium if we don't get the shares at that discounted price, which is perfectly fine. If we do, right? Technically, where you would own this stock, right, is you're going to own it for 9% down from current price, and you're going to get the premium of 6.5. So if you add those together, right, you're looking at about a 15.67% discount. You'd be buying the stock for about 15% down from its current price if you were to get assigned. So you get this, right, that strike minus your premium. Yeah, give it to me. I'm here for it, guys. This is name my price in the market. This is how you do it. You place cash secured puts, growth companies you want to own. Think long term. If right now if we went into a bear market, I would just hold these companies. I have no problem holding these companies. long-term outlook looks extremely good for these companies. Okay, that is my thought process. That's why I get into them. Um, so Oscar, I'm kind of shocked with Oscar on Fridays. I did not think it was going to get beat down this bad, which it's fine. Again, Oscar, given opportunities at 50-day moving average, has shown great strength here, as you can see in May, right? Rode this up, boom. Okay. We lost a little bit here in July, recaptured it at the 30, right? Recaptured it now, holding this 30-day moving average, holding it, holding it. So could we see the 50-day moving average be tested again? Absolutely. So what I would be looking at here for Oscar, and the reason I have a strong Oscar is my Hims and Oscar are my two largest holdings, I do believe. Okay, two largest. So yeah, did this hurt? Sure, but I we as you can see we were buying Oscar, I believe, somewhere in this 15 range. Okay, so we're up. Okay, sure. Did it suck having a minor setback? Yes, but is it a setback that I didn't see about 3-4 days ago? No. Okay, so I've been here before. Okay, same thing with Hims. Okay, same thing. Right. When's the last time we were at 50? Okay, we were at 50 September 26th. We've been here before. I'm not worried about it. Okay, just setbacks. You got to retest breakouts. You got to go find some volume down below just before you can take back off again. Okay, you got to get the other buyers in here before we can keep running. But Oscar, first of all, has great guidance whether or not the government gives ACA extensions. Okay, do we believe ACA extensions are coming into play? Yes. If you don't know what ACA extension is, it's the Affordable Care Act, Obamacare. Um, they were talking about getting rid of it. They're going to get rid of it eventually. Um, and essentially, it would hurt a lot of people in the world. Is this the best time to hurt a lot of people in the world with healthcare? Probably not. I would say definitely not, to be honest. It'd put a lot of people in a hurting position. Um, so, no, they're going to have to keep that alive. They're going to need to give an extension. Unfortunately, it is part of the government shutdown negotiations. So, they go hand in hand. Government comes back online, ACA extensions get put in place. So this is a matter, to my opinion, this is a matter of when, not if. This is just a matter of when. Okay. I think my personal opinion again on Oscar is that I see 18, 19. I mean, anywhere in here, I'm buying. Okay. I'm already loaded. Okay. My position is full. But I still think it's a great opportunity. They gave guidance already as far as without ACA even part of their business. Okay, an ACA extension is just going to bump their income and their bottom line for the however long the extension is. Okay, so they're not going to, they already gave, I can't even say enough. They already gave guidance without ACA, and their guidance, they raised their guidance when all the other health insurance companies lowered their guidance. Okay. And they're like, yeah, I mean, we like ACA obviously, but our business does not rely on ACAs. We knew this was coming. We planned for this happening. So management's handling it perfect. Okay. So I I believe in them. What do I see? I see this going back to 25, 35, longer term 12 to 18 months, 45. Okay. I think short term with the government and the ACA extension and everything and rate cuts all happening, I think 25, 35, more like 35, less. 25 is like the, I would say the bearish bull. The least bullishness is 25 to me. 35 is probably the median, and then 45 is like a true, like, things are, cooking, going well for us. So that's where I'm at on it. Okay. So what would I be doing? I would be waiting. Just give me another red moment down here, closer to this 50-day moving average retest. Get me down to this 1850 range, and then I'd be placing about a 30 delta, maybe even a little more aggressive. Um, you could be looking at your 18 strikes, or you could be looking at your 17 strikes. Is where I'd be looking. 200-day moving average is at 1550. A 17 would put you right at 1550, so you'd get to buy it potentially if it stayed under your 17 strike. You would own it for 1550. Amazing, amazing buying opportunity. Um, so let's go plug that one in. Okay, 17, and you'd get it for the middle ground would be 150. Okay, so if we did Oscar 17 strike, we got a nice $1.50. Okay, on 1121. What does that look like? Well, we are going to go ahead and look for about a 12% discount. This is where I was saying that this is, I don't know if a 12% discount with all the with rate cuts, earnings season, and ACA extensions pretty much on a timeline of the next 2 weeks. Even though they say it could be longer, I still would say I think all of the good news of a China trade deal, maybe the Russia Ukraine thing, that just kind of seems like it's like to me almost like a lost cause. Like it's just going to take forever for them to figure that out. But maybe that happens also. Rate cut, earnings season, ACA extensions, all happening November, like the last week of October into the first week of November. All of that happening, I have a hard time believing that by November 21st it will be under this. But to play it safe, to play your 30 delta, this would be the play. Okay. If you want to be on the more aggressive side, I'd probably go with the 18. Okay. And you'd be looking for $1.95, right? Because that's a 12% discount. I just don't know if it's going to get there. But if you want it more likely to get assigned, right, you do 18 at $1.95. Okay, you'd be looking at about a 7% drop. Okay, we'd be looking at about an 11% return in premium alone, which is amazing return in premium. But my always thought is I'm trying to get assigned. I'm trying to get these shares at a price I want to get assigned for, right? So I would get to own these for right there at $16 instead of 15.50, right? Is that 50 cents really going to be the make or break to me on this company? No. I rather get the shares than miss out on the upside potential on Oscar in the long term, especially with healthcare being so undervalued. Um, United Health, NVO, Oscar, HIMS. It's the undervalued sector, which is fine. That's why we've shifted a lot of our portfolio into that and out of AI. Almost stole my coffee. Out of AI and into healthcare, just because of the being undervalued. If we were to go into a bear market or a recession, healthcare tends to hold better than tech companies. Um, and HIMS and Oscar, all these guys are all using AI in their field. They're just in the healthcare sector where it's more consistent revenue stream coming in because no one's getting rid of their healthcare for the most part. All right. So I would go this route if you want to be more likely to be assigned. I would go this route if you just want to get the premium more likely and less likely to be assigned. 12%, looking at an 8.5% premium return, 91% annual if you can do this every 34 days. Okay. That's what I'd be looking at Oscar. Again, if you are a believer in Ethereum, if you don't know what these Bollinger Bands tell you, right? Bollinger Bands are a rubber band if you're a believer in Ethereum. Okay, there's one thing you need to know about Bollinger Bands. First of all, as you can see, it wants to just come down here and test this 200-day moving average, right? So come down and test it. Be my guest. You did it before after a drop from like 120 something. Okay. Yeah. 124 came raging down all the way to like 10, 13, somewhere in there. 10. Yeah. 9, 10, $10. Okay. It came down and it held that. So guess what? I'm going to probably guess that they are going to hold this one as well. Again, Ethereum with this administration, with the crypto and everything, that is I believe is just they're going to make it a thing at least for the next 3 years. I'm not going to miss out on what they find is important. I'm going to be a part of it as well. second largest holder of Ethereum, at least as of right now. So I think it's a great buying opportunity right at this 200-day moving average. If you can get a 30 delta, it'd be looking at 13 on SBET, which would be paying about a $1.06. So if we go take a look, SBET. Where do I see this upside again, in my opinion? I see an upside of $45, $60. Then we see probably a pullback because that's where the next kind of support resistance line is. See a pullback, and then we could get to 90 and back to 100. Okay. So the only way to not miss this, one, you're not going to time it because Friday, it could be down like it is now. Over the 2-day weekend, crypto news, whatever happens, no capital gains tax on Ethereum, no staking capital gain, whatever it may be. Monday morning, the stock will be at 100 pre-market. Like, you will miss it. The only way to not miss it is just to be in it. Okay? Could this be a miss? Sure. But investing in any crypto right now could be a miss. It's an investment. I'm going to side with our administration wants crypto to be part of the whole financial system. So therefore, Ethereum's part of that. If they're going to be the second largest holder of Ethereum, I want to be a part of the second largest holder of Ethereum, right? So if we were looking at 13, what was the premium? It was $1. Probably get it for $1.10. Okay. On 11/21. Okay. Another 8.5% in premium. Okay, we're looking for another 9% drop. All of these are lining up with about a 9% drop. This one's lining up with a nice 12% drop. Still getting about an 8.5, 8.5, 6. Okay. This is why we like red days. We're making money on red days. Okay. If I can get any of these are all 200-day pretty much moving averages, 50-day moving averages. RSI is nice and low, and the premiums are juicy. Okay. And great outlook for the next 2-3 years minimum, at least. Fubo, you guys know I'm a believer in Fubo based on the previous video. Okay. We're already here. We're already at this 200-day moving average. Okay. As you can see, all the small caps for the most part, Oscar, Bull, Hims, Zeta, PGY, I mean, they were red, right? You see all this red here. Okay, it's holding. Why? Because it's already close to its 200-day moving average compared to these other ones where Oscar was up here, right? Lagging was up here. 200-day moving average is way down here. Same thing. SoFi actually held green just slightly, but here, right, we have 200. So the support for Fubo's already there. Okay, we're already at the support. We have earnings, I think, end of this month, last week of this month. That's a catalyst. I believe is a catalyst is earnings season. Fubo rate cuts. Any small caps going to be rate cuts are going to help small caps because they can borrow money for less to help grow their business. But Fubo is going to what I believe on earnings with their shareholders approving the merger with Disney, which Disney is Hulu, ESPN, a bunch of streaming platforms. And then Fubo coming to the table now. Fubo can now say, well, we voted yes for it. What I think they're going to do is say, based on this partnership now being more or official, this is our guidance. Okay. And the guidance I think will be way higher. And what will happen? Will this thing overnight will be at 6, 10, somewhere in that range, I think. It's been literally consolidating in this range now since February. Okay. First of all, this is the first news. It was $1.27 or $2, and then it popped to 6. That was just the news that Disney and them were working on an agreement. Okay. And now the agreement's pretty much being put into place, and it's just been consolidating slowly between $4 and $2 since February, since that news came out. And now, again, buy it here at this 200-day moving average, and we're going to buy it again here at this 200-day moving average. I just had some shares assigned. Again, this is one that you might just want to buy some shares just because we're already at this 200-day moving average, or what you could do if you wanted to is go ahead and set the $4 strike. Okay. Hey, Colby, why would you do that? That's a 55 delta. Yes, I agree. Okay. That is a 55 delta. I just believe Fubo over the long term and the short term is going to go to the upside. Okay. And I don't mind owning the shares even at the current price. Okay. But $4 with the 65 cents and premium is actually buying it for less than the current price. Okay. So you take your $4 minus your 65 cents, you're going to be buying the stock if assigned under $4 for $3.35. Okay. That is currently 30 cents below the current strike price or the current price of the stock. All right. So I don't mind that. If I'm willing to buy it right this second for 365, why would I care that I do a $4 strike and take a 65-cent premium and actually own it for 335? Or if the stock continues to go up because of the news we predicted, right? And it goes past 4, well then I collected 65 cents in premium instead of doing my 30 delta and collecting half the amount of premium. Okay? What is that? What's the premium and what would you own it for if you did the 350, right? 350 minus, we'll just say 35. Oh, 0.35. Okay. 20 cents. Okay. It's a 20-cent difference. I'm willing to risk owning the stock for 20 cents more for a chance to pretty much double my premium or to own it for less than even 30 the current price. Okay. It just looks like this is more to me a more beneficial way of owning it, upside, downside, either way. Um, Along with the rolling opportunity if you want to roll. If you guys don't know about rolling, I'm going to make a video on that next. If I haven't, I don't think I have already. I will make a video on rolling. Okay. I do it all the time. What does rolling mean? Kicking the can down the road, buying it at a later date, and buying more, and collecting more premium. And you can do that. Okay. So I do the 4 at the 65. Okay. Let's go plug that into the calculator. We got Fubo. We're looking at the $4. We're looking at the 65 cents. We're looking at 11.21. Okay. What does that look like? Okay, yes, we are going to buy the stock for 9% higher than it currently is. Okay. What does that premium look like? Okay, well, that looks like if it goes past $4 in the next 34 days with earnings, with rate cuts, with the catalysts that are coming up for Fubo, um, I will collect 16% return on my investment in 34 days. Yeah, let's do that. Let's rock and roll. Or we'll get to own it for 335, which if I plug that in here, actually I can see. I would still be, if I get assigned the shares, I am still buying it for 8% lower than the current price. Okay. That was $4, right? Right. Which would be this minus this is where your break even would be. So you would own it still for less than what the current price is. I still find this as a win-win in my eyes. I don't know how you'd view it any different. Yes, I'm paying more for the stock than it is right now. But if I get assigned the shares, I'm paying less than the current stock price is right now. Okay. I'll take this 16% chance of the upside to still own it for 8% lower than it currently is. If it don't make sense to you, then don't do this one. But that's how I'm currently playing this. Okay. I will be setting, again, not financial advice. I will be setting these on Monday. I already own some shares. I got assigned this Friday at a cost of $370. Okay. Which is $364, right? I got assigned and I'm down 6 cents. I'm here for the earnings and the rate cuts at the end of this month. That's what I'm here for Fubo. Okay. I think there's just too much good stuff happening. I think it's consolidated for almost 8 months now. Longer the base, as you guys know, can have a huge run up to the upside. All right, Zeta AI marketing. Okay, this has had a tremendous run since April. Okay, we're down here at the 11. We've gone up to 22. Amazing run. Are we going to come down to test this 200-day moving average? Probably. Okay. Had the cross. As you guys know, that's a good bullish cross of the 50-day moving average crossing over the 200-day moving average. I would love to see this and buy it for the 50-day moving average. Actually, and then this is, as you, I don't know if you guys know this, but gaps, okay? Not every gap in the market needs to be filled, but the market likes to fill gaps. And what is a gap? It's, see this right here, the candle, and the next day it started up here. Well, there's this big gap of space that never got filled, and it got partially filled, but there's still this bottom gap. And as you can see, if we go to this bottom gap, it is lining up perfectly pretty much with this 200-day moving average. And that's where you're going to want to buy. Okay, it's going to fill that gap. You're going to want to buy there. So you're looking for a strike price of about 16.50. Okay, you could do 17, right? Because that premium will put you under there, which is perfectly fine. Okay, Robinhood's not going to give me the dates for November 21st, but we can go to November 14th. There we go. 17. You can get the 16, which crazy 1650 is a little bit more. I don't believe that would be the case. Oh, it's because of the spread. Okay. So you can probably get this 17 for $1.15 is what I would say, and you can probably get this one for $1. What would I be doing? 1650 would be the safer bet. 17, I'm super bullish again on this company. I'm bullish till the year end, at least to the year end. For all of these companies I'm talking about. As far as short term goes, long term, I'm way more bullish. Okay. But 17 is what I would look for if you want to get assigned the shares. If you don't really want to get assigned, like, not that you don't want to get assigned, but if you want to get assigned the shares at an extreme discount, um, but less likely to be assigned, you would do the 1650. Okay. What does that look like? I'm going to plug in the 1650 because that's at the 30 delta. That's at the 50-day moving average. As you guys know, if you were to get this 17, it would only be better, right? You'd only collect a little more premium. You'd be, right? Like, you would potentially make more doing that. But what I would do is I would do the 1650 at $1 premium. If you can get more, obviously, if you can get more premium, get more premium. As of right now, when I'm looking at these numbers, what I would see $1 and 1650. You get to own it for 1550, which you would get to own it for like down in this range in this consolidation zone, which is amazing. That's exactly where you'd want to buy it. Okay, so you got 1650 for $1. Okay, I'm gonna have to remove one of these. If I was to remove one, if I had to not do one of these, it hurts me to say, but I think SoFi has the most amount of potential to the downside to have to dollar cost average, where these ones are all kind of at more support zones. So I would go SoFi. Boom. Man, right? What was that game? You gotta, never mind. 1650, $1, and that's on 1114. Okay. $1. We got a 1650 strike, and we are doing this on Zeta. What does that look like? We're looking for a nice 7.5% discount from the current price to even get to that point. Which means actually, because what's Robinhood even show? Okay, it does show that. So 7.5%. You got a 606 in premium. So the reason it's also less premium is because it's less days. Okay, so as far as what the total amount of premium is, if you take into account, it's actually 606, 81%. Even though this shows 6.5% return, right? Annualized it because it's more days is actually less return annualized. Okay, so this is actually more return than it would be on Webull. Okay. That's why I like the annual return, because sometimes you just see this and you go, well, let me do that one. Right. These are all great opportunities in the market. But if you saw this, you'd say, well, 6.5% is better than 6%. But it's also one less week. Okay. And if I can get one less week, right, for and get to do more plays in the market, I can actually make more money. Okay. So that's what Zeta would be. Nice 6% return in premium if you only got the premium. And if you got to get the shares, you'd be buying it below the 200-day moving average. That is a buying opportunity. Again, great companies, growth companies under 200-day moving average is just equals opportunity is all I got to say. Okay. Home stretch here, final three. Okay, PGY went over in our last video. Okay, this thing was green yesterday to red to green. It was bouncing all over the place. Okay, again, we got a 33 here. So we got 33 RSI. Okay, it's bouncing here. It might get a nice little bounce here at 30 again. So this band is still trending down here. This one's kind of flattening out. Okay, what I'm seeing is this 200-day moving average at 20. That's a far drop. And there's a gap to fill. If we zoom in here, you guys see this little gap here. There's no connection of the candle or the wick or anything. Okay, so where's that go down to? 24. So could we see 24? Yes, to fill that gap. So that's probably where I would do my first move. Okay, I'm probably not going to put this one in the calculator. Only reason I'm not putting this in the calculator is because this is also just like SoFi would be a dollar cost average. So I'd be 24. Once it got below my 24 strike, okay, once it got to 224 or below my 24 strike, okay, I would be setting them wherever the 30 delta is, which would be like a 22, 21, okay? Still the 30 days out. What I'm not a huge fan of are companies that only give me the monthlies. I do like to have the weeklies just because depending on when that strike price is below my like, or when the stock price gets below my strike, all right, if I set a 24 and the stock started moving below 24, but we're only, a week, 2 weeks away from this, I would have to go out to this one, and this one just might be too far out, and I don't want to go that far out yet. Okay. Again, we like to look at expiration dates 45 days or less. Okay. So this is the hard part for me. I do like companies that have weekly just because it allows me a little more flexibility for rolling opportunities, more strike prices, more dates. Okay. You can still do it. Just know that you're going to be limited on the date situation. Okay. 30 delta would be 24, exactly that gap fill is. That's where we would want to. See how all these little things are lining up? We always go for a 30 delta. That's our default. Okay. Can we get a little more aggressive? Absolutely. It's our money. We get to do what we want with it I guess for the most part, if the bank lets us have it, right? But yeah, 24. Okay. 24 and a 30 delta line up. Sometimes I just think that's a sign. It's like, yeah, that's the one I got to do. There's a lot of volume happening at 26 right now. Okay. Where does 24 put us? 24 puts us right here in the middle. Would be we're looking at $22.45. So I just 250, right? So you would get to own this for 2150. Okay. Where's that put us? Well, that puts us right where that bottom band is. So that's exactly what I would do. I would start with the 24. If we get the strike and the stock starts moving to the 24, gets to 24, 24.10, anywhere close to it, right? Then you'd be looking for another 30 delta. Okay. This is currently $3 away from the current strike or where the current stock price is for the most part. So what would we be doing? If it got to here, you could probably start setting some 21s, 22s, which is going to be right below or right above this 200-day moving average. And then the premium of the 200-day moving average or the 21 strike would put you right below that 200-day moving average. And that's exactly where you'd want to own again. Okay. That's why we dollar cost average. We look for these big red moments, bottom band, red days. There's a gap to fill. There's a 200-day moving average, right? All of these things are lining up with what we're kind of looking for, right? If we get to this gap, right, we get there. Well, then what lines up next is the 200-day moving average. Then we try to get our strike close to that or get at least the least I would want is the strike minus the premium to get me to this 200-day moving average because then I would be like buying it when it's there. Okay. So that's PGY. Okay. What does that look like? I mean, basically, that almost looks like a 10% premium return, 8% premium return. Okay. Right in line with everything else that we're looking for. It's probably another 9% discount off of the current strike price to get there. Okay. It's lining up with all of these, right? Trying to get to this 9% discount, getting this nice 8-10% return. It's lining up. So PGY, that's what I'd be doing. All right, Lemonade. They just made an announcement with Tesla. It looked like they now are like streamlining auto insurance for Tesla. If you have never used Lemonade on their platform, I highly recommend. Okay, if you are investing in any company, I highly recommend just going to their website. Okay. Are they user friendly? I mean, like, just be a customer for a quick second. Go see what it's like. I've done Lemonade. I've done pet insurance through them. I've done a quote. Pretty much takes me about 2, 3 minutes to get a quote. I've done the auto insurance quotes, another 2 or 3 minutes of my time. It's an AI person, it's just like preset prompts. It's not even like an actual chat happening for the most part. But, they just say, "What's your pet's name?" Evie. Okay. Well, then they just go, okay, is Evie a dog or a cat? Right? It auto plugs. It's a preset prompt. They just once you enter your info, they now adjust that prompt to be custom to you. Okay. Um, Pretty much if you click yes or no, it's going to go down a different path every time. So super easy. Tesla being a huge part of the business can be massive for them. I think earnings for them is going to be huge as well. I think this is $100 stock potentially by the end of the year. Maybe it can push that high. I mean it was 62 recently, so I think it can easily get back to 62, and it already hit it twice. Try to break that barrier. If we can go ahead and break through 62 on this one, yeah, I see the run up happening. Okay. I don't even know. Is this all time? Yeah, look at this. It's already been up here, 188. So we're going to 116 maybe. Just this tiny little mountain right here. Okay, could we get back there? Absolutely. Okay, I think this is another buying opportunity. Nice double up. Okay, so what would I be doing? I First of all, it's at the bottom of the band already. Okay, so could you get it for here, 39? What I would be doing is playing the it's not going to fill this gap. As you can see, this gap is below this 200-day moving average. It might fill the gap eventually during a market, bear market happening, right? We could have a run up and a pullback, whatever. I don't think it's happening at this quick moment, but I would just run the 30 delta. Okay, run our strategy. Red days bottom band 30 delta. Okay, where's the 30 delta even put us? Puts us at 44. Okay, well, 44 is below the band, so awesome. It might not even get to 44. And if it does get to 44, we're going to get a nice, wow, look at that spread. Oh, I'm on November 14th. Give me November 21st. Can I get the 30 delta? Oh my gosh. Give it, whatever. All right. That spread is ridiculous on there. 44. Again, take a look at what the 30 delta would be on November 21st when market opens. Because it's a monthly, the premiums are better, the volume is better, all of that. That's why I see how the volume is kind of nothing. Maybe November 7th will give us to us. Okay, more volume on November 7th. So 30 delta is still 44. We have that's a big spread. You want a tight spread when you're doing these, okay? Big spreads kind of give you bad fills. Um, it's just because there's not a lot of volume happening on here, as you guys can see. Root is a very similar. Go to a 30 delta, get filled, find the mid, try to get as much premium as you possibly can. It is going to be close to a 9-8% premium. You're going to be buying this stock for close to about a what is that, 10%, 9% discount, and then getting about a 9%, 8% premium on it, with a very good outlook for the future. I think they're a insurance disruptor in the field. They are going to pretty much upset a lot of people, like Hims is in healthcare. They're AI. They are coming to take all these big company, and they're going to make life hard on them. They're just going to, all right? You can't beat, unfortunately, and I believe AI is bittersweet. It's amazing because it can be super fast, super efficient. We get our answers, what we need right away. As like I said, I prefer going to Lemonade and getting my insurance quote in less than 3 minutes, right? I don't want to call somebody, give them all this detail about what I do, blah, blah, blah. Then they give me a quote. It's too high. They say, oh, let me get it down a little bit more. No, I don't want that. Take that guy out of the equation. The AI guy can freaking just plug it all in. They can give me my quote. I say yes or no, and I move on. Okay, you're not going to beat that with the human. Unfortunately, I love humans, but Lemonade is going to win this battle, and Hims is going to win this battle with direct to consumer healthcare, going straight to your door, subscription based, low cost. Okay, they're going to win that. Custom to you. It's not some generic medicine. This is custom health to you, to your body. Lemonade, custom to you, quick AI, straight to you, no middleman. Get them out of there. Okay. So 30 Delta, look at November 21st. You're looking at probably a 9% discount, 8% premium, somewhere in that range. Dollar cost average, I would do that 44. And then if we got below that 44, then I'd be setting the 40 right at the 200-day moving average. Okay. Most of these are going to be a two buy plan. Some of them are already a buy. And then Roots in the same way. So here's Root. Okay. We got this. We got this little death cross, is what they call it, right? Now, I'm not a huge fan of catching the falling knife, okay? Because I would hate to say catch this and it fills this gap, okay? That's kind of what my thought process is because lemonade is such a huge catalyst, and right now the its momentum is starting to pick up for Root as far as like the social aspect of it on social media and everything. The band having this big dip and then kind of rebounding was huge for it. That was a big part. But what I'm doing, keep this on your watch list, okay? Because Root is a disruptor just like Lemonade, and they're in the same field. Root is just smaller as of right now, okay? But potentially a gap fill. I don't know if it's going to get down that far. It might. Okay. But what I would look for is wait for this to recapture the 50-day moving average. Okay. Wait for it to get back above your 50-day moving average, just like it did here. So, see, got above. Okay. Now we wait. Okay. Now we wait for it to kind of get to this bottom part of the band because this 200-day, 50-day moving average crossed over. When the 50-day is over the 200-day moving average, that is now considered like a bull trend, bullish trend. Okay. Same thing here. 50 days, the purple line crossed over the golden 200-day moving average. Okay. Now we're in a bull. Okay, now we went bear a little bit. Now we pop back over bull. Okay, so I'd wait again until this is above this because as of right now, as you can see, it touched it, but it rejected it. It didn't want it, so it's going down further. So you want to wait till it can reclaim the 50-day moving average. Can you have it break to the upside and still get back under it? Absolutely. Okay, it's part of it. What I'm saying is wait till it regains the 50-day moving average. Okay, wait till you see this whole shift happens. Okay, so basically, same thing here. Okay, see how it kind of went under it? Okay, and we waited, we waited, and then it obviously busted up, which is awesome. Good earnings would be my assumption. And what I'm looking for here is it to regain the 50-day moving average, and I want to see it stay above it for at least a month. Okay, yeah, I'm not going to buy it at the bottom. I'm not trying to buy it at the bottom, but I want confirmation that the bottom has been found before I go ahead and just put my money into it and then it keeps falling. Never go catch a knife. Okay. Do not catch a knife. I don't know how many times I want to tell you guys this, but don't think that the bottom is in until you see that the bottom is in. Okay. Those are my plays. 30 Delta, November 21st. I mean, wait till it's reclaimed, okay? But again, you could be buying them, looks like a nice 70, which is $5 lower than the current price, which is about 8% discount. I mean, all of these are kind of lining up there. The spreads are really big, right? It's not the moment for it, but this is one I would keep on your watch list, okay? Um, the other nine ready to play. They're all ready. Okay, rock and roll. Those are my picks. If you guys have any questions, please put them in the comments below. If you guys want the tracker, okay, the link is down below. This is an amazing tracker, sorry. If I adjust how much funds are available, all the contract amount will change to match however many max contracts you can do based on that funds. We have cash secured puts calculators. We have covered call calculators, poor man covered call calculator, covered call rolling calculator. And when you do get the spreadsheet, there is a tutorial on how to use everything inside of the spreadsheet. Okay, so you're not just getting it and you're left all to your lonesome. Um, this is if it's worth closing my position early. That is just like if you're already waffling yes or no, and this tells you yes, that's like a confirmation. Okay, this isn't the end all be all. There's a break even calculator. Total wheel log gives you your kind of averages. Here's Weeble. Okay, let me zoom out real quick. Let me get you a nice zoom out. Okay, so keep track of your overall profit, your wheel profit. Okay, if you had the shares in here, it would tell you all of that stuff. Like I can show you Archer. Okay, so average cost is what I own the stock for or what my strikes were. And then after all the premium I've been collecting, it's brought my cost basis down to $8.19. Overall profit, wheel profit, if I was to execute at the strike price, what the strike profit would be, total profit if it was to be exercised. All the details are here. This is exactly what you need if you're going to run this wheel strategy, and is an amazing product. I'm not just saying it myself. There's reviews. Links are in the description below. Please like and subscribe. Leave whatever comments or questions you may have. I will make a video on it. I appreciate you guys. See you in the next one.